I know, I'm here for you. All right, thank you everybody for joining us today for the Management Committee on August 28th. Welcome. We have a quorum, so we will get started. Everybody's received the agenda in advance and had a chance to look at it. Without any objection, the motion, we don't need a motion here. All right, thank you everybody for joining us today for the Management Committee on August. We're gonna fix our technology real quick. Make sure we have sound off on the devices. Okay, good. Now we're back in order. All right, so without any objection, the agenda is approved. We've also received the August 14th draft meeting minutes of the Management Committee. Everybody's had a chance to review those as well. Are there any questions, edits, comments? All right, then seeing none, I would entertain a motion to approve the minutes of the August 14th Management Committee meeting.
So moved.
It's been moved by Cedarburg. Is there a second?
Second.
Seconded by Lee. Any further discussion? Seeing none, all those in favor say aye.
Aye.
Those opposed, no. And that passes unanimously. So we are now on to our non-consent business items, the reports of standing committees. We have 2024-188. It is a joint committee report, and it is our third quarter budget amendment. We've got Stuart McMullen, who is our Director of Budget, here to present on that. So welcome, Stuart. Great to see you.
Madam Chair, good to see you all as well. I'm Stuart McMullen. I am the Budget Director here at the Council. Ed Petrie, the Finance Director at Metro Transit, is also here to answer any questions we might have on the third quarter budget amendment 2024-188 JT. This makes changes to the 2024 operating budget in Regional Administration, MTS, and Metro Transit, and changes to the capital budget in Community Development, MTS, and Metro Transit. The amendment was reviewed and passed by the Community Development Committee on August 19th. It was heard by the Transportation Committee this past Monday, August 26th, but there was not a quorum present, so it was not voted on. If it is passed by this committee today, it will go back to the Transportation Committee for formal action on Monday, September 9th. If it is passed there, it would then come to the council at your next council meeting on Wednesday, September 11th. Notable changes to the operating budget, first in Regional Administration. It adds 7 FTEs in Information Services who are currently 2-year temporary staff. So this is budget neutral, but adds to the budgeted FTE total in Information Services. It brings forward $1 million in IS that is in the 2025 preliminary budget for increased network security, brings it forward into the 2024 budget so they can continue to accelerate the timeline for that work. It adds 6 FTEs in procurement for additional contract and vendor management efforts. It adds 5 FTEs in OEEO for additional analysis and compliance efforts. 2 of the 5 are in the recommended increase for 2025 that are being added now so they can be brought on board sooner and therefore won't increase the recommended budget for 2025. It adds 5 FTEs in HR for recruiting and onboarding support and adds 1 FTE in government affairs and community relations. These changes to the RA budget will be allocated to the operating divisions. In Metro Transit, it adds 4 FTEs to bus operations for safety and state of good repair work. Funding for these positions was already included in the budget, but we're adding the FTEs to the roster, but not the expenses. In MTS, we're increasing the expenses and use of reserves by $3.5 million for Metro Mobility for higher than anticipated contract settlements and expenses. And we're increasing the expenses and uses of reserves by $2.5 million in fixed route for higher than anticipated contract settlements and expenses. Changes to the capital budget includes adding $61 million in federal funds for the Green Line Extension project, adding $28 million in regional sales tax for the materials management storage facility, adding $11.6 million in regional sales tax for the H-Line project, and adding $9.5 million in regional sales tax for the zero emission bus transition plan at East Metro and North Loop garages. In MTS, it adds $40 million in federal funds for 10 projects, primarily small bus replacement projects. The individual projects and their changes are outlined in the attached tables 9 and 11. So therefore, the motion is that the Metropolitan Council authorizes 2024 unified budget as amended and in accordance with the attached tables. Stop there and answer any questions the committee might have.
Thank you, Stuart. Are there any questions, comments, anything? So we do have them in the staff recommended motion that the Met Council authorize the 2024 unified budget as amended and indicated in accordance in which the attached tables, which we've all had before us. Is there a motion?
So moved.
Moved by Barber. Is there a second?
Second.
Seconded by Cedarburg. Any further discussion? Seeing none, all those in favor say aye.
Aye.
Those opposed, no. That passes unanimously, and I'll go back to transportation. All right. With that, we have another non-consent business item, and that is 2024-225. This is a same week item. It will be going to the council tonight. It is advanced, and it is the labor agreement with the International Association of Machinists and Aerospace Workers, District Lodge number 77. And we have Alexis Baker, who is our Labor Relations Program Manager, with us today. Welcome, Alexis. Thanks for being with us.
Thanks, Chair Johnson and committee members. My name is Alexis Baker and I'm a Labor Relations Program Manager with the Council's HR Department. I'm here today to present our tentative agreement with the International Association of Machinists and Aerospace Workers, District Lodge number 77. The contract expired on December 31st, 2023, and this group represents approximately 55 employees who perform maintenance and fabrication work in environmental services. The parties reached a tentative agreement on August 9th, 2024, and it was ratified by the membership on August 12th, 2024. Highlights of the agreement include a 3-year contract effective January 1, 2024 through December 31, 2026. A compensation package that includes the general wage increase in year 1 of 5.5%, in year 2 4.5%, and in year 3 a 3% general increase. And lastly, employees will also have the opportunity to earn 2.5% in performance pay each year of the contract. These wages and benefits negotiated in the agreement are consistent with the agreements in place with the council's other labor unions. The cost of the labor agreement was reviewed by finance and was negotiated within the economic parameters established by the council. And so, Madam Chair, the action requested today is approval to authorize the regional administrator to enter into a labor agreement with the International Association of Machinists and Aerospace Workers, District Lodge number 77, effective January 1, 2024 through December 31, 2026.
Thank you very much. Are there any questions? All right, seeing none, we appreciate the hard work by the team that has put this together and another good one to pass on to the council today for final approval. So thank you for that. All right, we've got the motion as stated by staff. Is there a motion by the members of the committee to move forward? Moved by Lee, is there a second?
Second.
Seconded by Pacheco. Any further discussion? Seeing none, all those in favor say aye. Aye. Those opposed, no. And that passes unanimously, so thank you very much. We appreciate your presentation for all your hard work. We'll be bringing that to council today. We'll now move on to the information item section of our agenda, and we first have before us the quarterly investment review committee report. And again, Mark Thompson is with us, our Director of Treasury. Welcome, Mark.
Thank you, Madam Chair.
Turn it over to you.
Members. Mark Thompson, the Treasury Director, and I'm here to present investment review informational item for the second quarter of 24. This is a summary of what was discussed at the Investment Review Advisory Committee meeting on August 13th. I have a presentation of about 9 slides. I'll touch on the economy for a few slides and then touch on each of our 3 portfolios. I think.
There we go.
There we go. Just a little bit about economic growth in the second quarter. This slide shows the growth as measured by GDP for the last 6 quarters or so. Growth was stronger than expected in the second quarter. It came in at 2.8%. This is the first of 3 GDP measurements for the second quarter we'll get, so it's subject to a revision, but handily beat expectations of 2% and handily beat the first quarter number of 1.4%. So it was a strong growth quarter. Although it was a little bit, you can see it was quite a bit lower than the the third and fourth quarter of last year. The biggest surprises were the strength of consumption, strength of business equipment spending, and large increase in federal government consumption also. One of the biggest risks to GDP going forward is going to be the labor market, and I'll touch on that in a moment. First, inflation. Inflation there was good news on inflation for the second quarter. This slide shows on the right side of the slide, if you can see it, that inflation trended lower for the quarter after we had a little scare in the first quarter. If you recall, late in the first quarter, inflation jumped up, but the trend turned lower again in the second quarter. It finished. The CPI is a measurement of inflation that came in at 3%. At the end of the second quarter versus 3.5% at the end of the first quarter, so that was a good trend. The Fed's often looks at the core PCE, it's called, which was down to 2.6%. As you know, the Fed's been focusing on inflation for the last 3 years or so, as they increased interest rates to try to bring inflation down to their goal of 2%. So we're not quite there, but they've been largely successful at bringing inflation down, and they're very comfortable and it's going to meet their goal. Again, this trend lower is good news, and combine that with the cracks in the labor market, which I'm going to talk about next. It's certainly opening the door for the Fed rate cuts that you no doubt have heard are coming. And since this chart was prepared, we have July CPI came out at 2.9%, so the trend lower continues. A little bit about the labor market. This is really where the attention has turned to in the financial markets and for the Fed. It's really become the main concern, and this chart shows a number of labor statistics, and I'll quickly touch on most of them. This was produced a few weeks ago, so it's a little bit old, but you can see that the payroll numbers, which is the non-farm payrolls, that's jobs added to the economy each week or each month. You can see that's been trending lower. If you see the dotted black line, that shows a 12-month average is clearly trending lower, and it has been for quite some time. The employment rate is rising. This was through June. On the upper right shows the unemployment rate. Since this was produced, it's jumped up to 4.3%, so it's continuing to go up. Average hourly earnings continues to trend down. That's in the lower right graph. And since this chart was produced again, the July employment numbers came out, the payroll numbers, which had averaged 249,000 in the first quarter, came in at 114,000 for July, so way under half of what it has been, so that was kind of a shock to the market, and really kind of some negative news. So then I don't know if you watch the financial news, you probably heard last week that non-farm payroll numbers, they do an annual revision. So the Bureau of Labor Statistics revised their payroll numbers for a 12-month period from March of 23 or April of 23 to March of 24, and they revised jobs added down 818,000. So what's been previously reported as payroll growth isn't been as robust as previously reported. So the labor market's clearly deteriorating, and it's causing a lot of concern, and it's giving more ammunition to the Fed to start lowering rates. I'll just mention the August labor report comes out September 6th. That's going to be very closely watched by the markets and by the Fed. Treasury yield curve. This is kind of the interest rate environment that we operate in when we manage our portfolios, and this is showing what rates did over the second quarter. The green is the end of June. Now Again, this was produced before our IRC meeting a couple of weeks ago, and it's dramatically changed. For instance, I'm gonna give you a couple of quotes. The 2-year is now at 386, where you can see here it was, over 4.5. So rates are off this chart lower, which is amazing. Through the 5 years at 366, this chart shows it at end of second quarter at almost 440. So it's the rates of, the market's already pricing in the expected interest rate cuts, which, we expect to be 3 cuts yet this year, starting in September. So we're gonna see this curve dramatically change. Our short-term portfolio invests on the very far left part of this curve, very short-term investments, and, that's close to, 5.25, 5.50 almost. As the Fed starts decreasing rates next month, that's gonna drop significantly, so this curve will no doubt change a lot. In fact, they're pricing in over 100 basis points this year, which will drop that left side of the curve all the way, down to 440 or so. So we should see this curve really change. Our longer term investments are kind of in the middle of this curve, which is gonna go down also, maybe not quite as much. I kind of expect this curve to flatten out, but fortunately, we did make some purchases in our long-term portfolio, and that to lock in some of these yields out to 2 to 4 years before these yields dropped, fortunately. So I'll talk about the long-term portfolio in a second too. Touching on the equity market, this is showing a graph of the S&P 500 index you're all familiar with. It returned 4.28% for the quarter. This is something I show just because we have exposure to this in our OPB Trust. For our general investments, we cannot invest in equities, but we can through a special statute for our OPB Trust. So you can see the equities really followed inflation expectations over the quarter. I've put the monthly returns at the bottom here also to give you a little idea, but we had some really hot inflation reports in April and stocks came down a little bit. Followed by more favorable inflation in May and June. And July really was a volatile month. I know that's out of the second quarter, but really the trend, the upward trend continued in the first part of July, and then we ran into a situation where the market started to feel that the AI rally was a little overdone. So we saw kind of a reversal out of tech the second half of July. So that was up and down. Like I said, the index returned 4.28 for the quarter. And as of today, it's still up 18% for the year. So far so good for the year, which is good for our OPB Trust, which I'll show you more details on in a moment. I also wrote in here that it's 67% of our OPB Trust, which is higher than we like it. So we did make an adjustment to bring that down to our goal of 60% exposure to equities in that portfolio. So I will touch on that in a moment also. The short-term portfolio, this shows you the left chart shows you the allocation, which really hasn't changed from quarter to quarter recently. It's a $1.39 billion in the portfolio. Still in 40% treasury bills, 36% discount notes, and 24% in money market funds. Much the same as it has been for the last few quarters. Total return for the second quarter was, I apologize, that first bullet there says first quarter total return, but that's the second quarter total return was 1.31%, right on its benchmark of 133. Average yield in the second bullet on the right shows you that's pretty much leveled off. It's been pretty steady the last year or so. Again, that is subject to the upcoming rate reductions from the Fed, so that may change in the quarters to come. Interest income is pretty steady around $17 million a quarter, and it has been for the last year or so also. The long-term portfolio, this is a $471 million portfolio. Again, This is a little longer term portfolio. It's really our longer term reserves versus the short term, which is our kind of our cash management portfolio, but you can see the allocation here, it hasn't changed a lot either. We're in government agencies, US Treasury notes, municipal bonds, CDs, and money market funds. We did add a bank to our CD program in the last council meeting, so that will be bumped up. I expect a few more million. That program is authorized for 25 million, so we're gonna add one more bank and we'll have that program filled up, which is good news. On the right side, total return was 1.04 for the quarter, which handily beat its benchmark. The book yield jumped up to 217 from 190. Duration is 1.46 years, which is longer than it has been as we're trying to extend this portfolio a little bit to lock in these yields before they go down. So we've been making some reinvestments of maturing securities as they happen. This is a longer term portfolio, so we don't see a lot of turnover, but we're making reinvestments as we can. The interest income was $2.5 million for the quarter, which is slowly but steadily increasing over the past year. And finally, the OPB Trust I mentioned. This is over at the state board, managed by the state board, and we have authority to tell them how to allocate it. 3.02% for return for the quarter. You can see the average returns for 5 and 10 years are great. This has really been a good story for us, and the trust value increased this second quarter from $353 million to $364 million. Again, the equity exposure was at 64% or 67%, $243 million, but we moved about $20 million out of the equity bucket into our cash pool to bring that down closer to 60%. We are going to be making a withdrawal from this portfolio to pay OPEB expenses in September, so that's an annual process we go through, and we'll be using some of that $20 million that we moved into the cash pool to pay for those. Our projected OPEB liabilities are fully funded, so we're in a great spot with this portfolio. And that's all I have. I'm happy to answer any questions.
Thank you, Mark.
I know I talked too fast, probably.
Well, we'll let you know if it's an issue. We're tracking with you, especially just having these quarterly reports and continuing the conversation is very helpful, and then all the nuance of what we're going through right now and why the markets are reacting the way they are, and then of course it's an election year to just throw in some extra fun. So are there any questions on behalf of the committee? All right. Well, thank you, Mark. If we do have any questions, we'll let you know, and appreciate you being with us today. Thank you.
Sounds good. Thank you, Madam Chair.
Yes. All right, our next item on our information portion of the agenda is the 2025 health and dental premium rates. And we've got Marie Henderson, our Deputy Chief Financial Officer. Thanks for being with us today, Marie. And anxious to take a look and see where things are going for 2025.
Yeah, thank you, Madam Chair and committee members. My name is Marie Henderson. I'm the Deputy CFO here at the Council. And I'll be reviewing with you today the 25 self-insurance rates, the recommended rates that are being proposed through our self-insurance. Medical is what we're going to focus on today. And it has been reviewed by our Comp Labor Committee that is internal. It's been sent to our executive team for information, and this will be presented to our Labor Management and Benefit Advisory Committee on September 9th for all of these recommendations. We have been self-insured on medical since 2013 and for dental from 2014. We have three main principles for setting our rates that we've had since the inception of being on self-insurance, and I'll go through those today. The main principle is to make sure that our premiums are set to cover our costs. Our costs are set by an actuarial Aon, who's our consultant at this point. They project out costs for the next year using enrollment for the current year, which it was taken as May of 2024. With the projected costs, the gap for funding for 25 is 6.4%. This covers a total of a little over 4,000 employees and family benefits, and they calculate units, so including like children. This covers about a little bit over 7,000 people. Last management committee, you voted on business item 2024-177 for active medical claims. That's going to the council this evening, so it has not been voted on at this point. If this were to pass tonight, then this will be the plans that we'll have. If it doesn't, and we need to regroup, then you'll have me back here to have a different look at the medical. But currently, we have 3 plans. One is open access, but that plan is only available for members of ATU. We have distinctions, which is a copay plan with deductibles, and we have a high deductible plan for HRA. The council also contributes, if you're in that HRA plan, the deductible to the employee. So the cost of that plan for 25 is estimated about $3.8 million to supplement that deductible to the employees. Compared to last year, it was $3.5 million. So getting into our rate setting principles, make sure that the plans cover the costs within each other's plans. We have kept open access separate because it's not open to everyone, so their costs are contained within that plan. And we have combined distinctions and HRA plans together. So when we look at the funding gap, that 6.4% is actually 5.5% for open access, and distinctions in HRA is an increase of 6.8. But when you blend that together, it's 6.4. And dollar-wise, the total funding gap is a little bit over $5.5 million. 4 of that being in distinctions in HRA and $1 million for in open access is the projected rate. We also each year with Aon look at each of the plans individually just to make sure that because we're combining distinctions in HRA that they don't offset each other too much. HRA, because it's funded through the council with the premiums, is about equal to the offset of the higher upfront claims on the distinction plan. So we still look at those to make sure that they're set correctly. And the analysis still came back this year that combining distinctions and HRA at that 6.8% increase, and of course open access standing on its own at 5.5 still makes sense for our rate setting strategy. Just to remind everybody the 24 rates. Now these rates are the monthly rates, and this is the full premium. This is the employee and the employer share. Each of the union contracts dictate how much the employee pays versus the employer. So taking the percentage increases, this is the projected amounts for single and family for each of the respective plans. Again, these are monthly rates and it's dictated by the union contract. So on average, single coverage is about 10% for the employee. For family, it's 20%. It's not the whole amount. I will also remind everyone that these rates, as compared to private industry, are very low compared to other government agencies. We're right on line, if not lower for some. It's just a tough number sometimes to look at. We also, because we are self-insured, we have to do some risk mitigation. And that is, we make sure that we have a reserve balance. We make sure that we have a reserve balance for cash flow because our monthly bills don't come in linear throughout the year. Some months are heavier than others. So we also have to make sure that we can cover some uninsured losses that come up. And we do, because we are self-insured, we have an insurance policy on ourselves for stop loss coverage for claims that are over 750. And in aggregate, our claims will not go above 125% of the expected claims. So the first slide said 94 million times 125. Our claims expenses will not go over 1,118,000. By setting the third principle then to have that minimum reserve target balance, we have policy number FM 2-3 is our target fund balance policy. It sets the target balance for self-insurance between 25 and 35% of the annual budget operating expenses. We do this to mitigate risk. Unexpected things come up. It's proven time and time again that we have those targets. We make sure that we minimize that risk and that we are able to really keep our premiums from fluctuating too much, but they do. Just for some information slides here, for enrollment, the red line is really what we had for 24 enrollment, and green is 23 and 22. So you'll see there is some migration happening to the higher deductible plan, which is good, and that's why principle number 2 is we look at each plan individually. So if we have some high migration into HRA, meaning the council's putting in for that deductible, we'll have to relook at the principles, but for right now, it's all within a tolerable range. Also some fun facts here about our rates. In the red line is HRA and distinctions rates that we have set throughout the years, and the green is for open access. In 20 to 21, we made the decision because we weren't sure what was going on. We knew that open access, again, keeping its costs within itself. We had a 5.7% increase that year, but we held distinctions in HRA at 0. Now things happened, a couple things by holding those premiums. We had an increase, a very large increase in health costs coming out of the pandemic, and we had higher claims. People that postponed their normal physicals might have had a stage 1 cancer, but maybe because of not going to that appointment, all of a sudden have at stage 4. So we did use some of our reserves because of that and those high costs. We weren't setting our rates as unexpected things had come up. And so we used actually in 22 and 23, we actually used reserves. But I think the point on this slide is that our premiums are coming back down post-pandemic, which is good to see. The blue line running across is the rates of medical trends. The 25 trend is actually going closer to 9% at this point. So we will continually see increases. So jumping a little bit ahead on the reserves like I was alluding to, we did use reserves in 21 and 22. We used $6 million of our reserves each year. Last year, between the blue lines of 22 and 23, you can see we gained back $3 million of that. So we still are above our target, at target, I would say, at that 35%. So there is, unexpected things could happen. We could still be okay, but we're being at target. So we have to be really prudent by setting these rates the way they are. And again, 6.8% or 5.5% is still within a good market range. Today I did not talk about dental. This is the reserves for dental. We have set our rates actually in 2014, when we went live being self-insurance, and we have not had to change our rates since then. So we're working with benefits to really make sure that we have some campaigns about people using their benefits for dental. It has proven time and time again, a happy mouth really makes a healthier person. So it's really important to make sure that we still have people using their dental benefits. So with that, that's setting the rates for 25. If there's any questions.
Thank you, Marie. Are there any questions? Any questions at all?
I
I just have one, Marie, since our debt rates have remained flat since 2014 when we set them, and our reserves are well above our reserve target, would there be any consideration to reduce that, or is that just kind of a inconsequential thing, or how does that, stand, I guess?
Yeah, Madam Chair and committee members, the amount difference is about $4 million. That graph looks, as you can make graphs look, very disproportionate. There's not a lot that we could do. We have on the medical side in previous years, pre-pandemic, given incentives for vaccination cards, and we did a one-time contribution into people's healthcare spending account. $4 million would not quite cover what we would need to do for that type of incentive, but it's something to look at.
Okay, thank you. Anything else on this? All right, well, I appreciate it. We do have that item on consent tonight at the council to approve our payments, expenses. So that'll, I'm sure, move forward. And thank you, Marie, for taking time to be with us today and walk through all of this. And it is good news, so appreciate your hard work on that and the whole team as well. All right, we are now at the point on our agenda, which is item 3, where we will entertain a motion to go into closed session. Does anyone have a motion for me? Councilmember Pacheco?
Yeah, I sat in the wrong chair.
We got volunteered.
Madam Chair, I move that this meeting also be closed to the public pursuant to Minnesota statutes section 13D05, subdivision 3B, and applicable case law, so the committee can discuss with our legal counsel in a confidential setting attorney-client privilege matters.
Thank you,
Second.
Councilmember Pacheco, seconded by Lilligren. Before we take a vote, I'll just mention that a public body by majority vote in a public meeting may decide to hold closed session meeting under sections 13D.05, subdivision 3B of the Minnesota Open Meeting Law to discuss attorney-client privilege matters. Discussing these litigation matters in a confidential setting will permit the council to engage in candid discussions and resolve these matters in a way that benefits the council and the public. Discussions during the closed portion of this meeting to discuss attorney-client matters will be confined to the pending litigation matters listed on the committee agenda. With that, I would, we got a motion, did somebody make a motion too? Okay, we got a motion. Moved by Lilligren, what was it?
Moved by Pacheco.
Oh, Pacheco and Lilligren, thank you very much. All those in favor say aye. Aye. Those opposed, no. And that passes unanimously. So again, as we get ready, thank you. Before we close the meeting to discuss pending litigation, I just want to inform members of the public who are monitoring this meeting and for the record that the committee will adjourn immediately after discussion of the information item and that the committee will not have any discussions or conduct any business after this information is complete. So for the record, please note that this meeting was closed to the public at 3:09 p.m. on August 28th, 2024.